Let me say before I start how thrilled I am at how our team has developed. Not just the people who you see behind me and the people who came up on the podium, but in fact all of our staff. Recently, a person who's applied for a job during the course of our interview said to me, "What would success look like if I came to work for you in, say, 3 months?" And my answer to her was, success would be if you are working well with everybody in the firm, that you're helping them, that they're helping you, and that together we're getting the job done for our clients. We're very much a team at Baskin, and one of the reasons that we wanted Rob to introduce these people to you and have Scott talk to you about the new initiative in terms of portfolio associates is so that your exposure grows, that more people know about you and your family, and that you'll have more points of contact with the firm. So that's the looking inward part of our presentation tonight. I'm now going to talk about the looking outward part. Those of you who've been clients for more than 10 years, raise your hands, people who've been clients for more than 10 years. Yeah, there's a lot of you. We'll remember that prior to the great financial crisis of 2008, we had investments outside of North America, primarily in Northern Europe, but that after the crisis we withdrew from those markets and became very much North American-centric. Most of our investments were in Canada and increasingly in the United States. What I want to talk to you about tonight is increasingly putting our focus on the rest of the world and the reasons why we think that's a good idea and how we're going to do it. So if you'll turn to your booklet to page 9, those of you who've been here before know that this is very booklet intensive. I'm going to make you read those charts. One of the things that we do as people, and it's very difficult to avoid doing it, is focus on our recent experience. This is what's referred to as a cognitive bias, and this one is called the recency bias. We tend to remember what we've experienced, and the more recent that experience has been, the more real that is to us and the more it forms our expectations. So the first graph on this page shows you the level of interest rates since the end of the Second World War. And for most of the people in this room, I happen to know that when we think about interest rates, we think particularly about the period from about 1965 to 1990. Because for most of the people in this room, that's when we bought our houses, raised our families, and were most interested in borrowing money. But I have to tell you, that was not the typical period. And because we're focused on that period, we're exhibiting recency bias when we say things like, boy, interest rates are low. How can interest rates stay this low? Interest rates have never been this low before. Well, ladies and gentlemen, that's just wrong. As I've talked about in previous years, interest rates have been this low, sometimes for centuries on end. Our recency bias fools us. And if you look at the graph at the bottom of the page, this is really important to what I'm talking about tonight. This is a graph of economic growth in the United States over the same period from the end of the Second World War. And let me tell you, that is a terrific graph. Economic growth in the United States has been fantastic. I don't want to sound like some guy with orange hair, but it's been terrific. The United States economy is 10 times larger today than it was at the end of the Second World War. The United States became a global economic colossus. It rules the world. The US dollar is the reserve currency for the world. The US stock market is the biggest stock market in the world. When we think about economic power, we think about the United States. But I want to tell you that when we think that, although we're not wrong today, we're falling into the trap of recency bias. So please turn the page, and I want you to direct your eyes to the very colorful chart on the top of page 10, which takes a much longer view of history, a 2,000-year-old view of history, And if you look at that chart, particularly the left-hand side of the chart, you'll notice a very large red area and a very large orangish area. The biggest economies in the world for most of the last 2,000 years have been China and India. When the Portuguese made it around the bottom of Africa, crossed the Indian Ocean and made it to the west coast of India, they were astonished at what they found. The Portuguese, who thought they were doing pretty well, were dressed in roughly woven woolen clothes, and they found the residents of India dressed in silk and cotton, bejeweled, and living in a style to which no European could even hope to match. The wealth of the Indies, still a phrase that we remember now 500 years later, amazed the Europeans. At the same time, the Chinese had a culture, although inward-looking, which was richer, more homogeneous, and in all ways wealthier than Europe. We forget this at our peril. We forget this at our peril. And as the American century began, and as America became richer, and as those economies, particularly in Asia, faded in comparison to the United States, we lost sight of the fact that these are the most populous countries on earth, and ladies and gentlemen, they are re-emerging as the most powerful economies on earth. If you look at the graph on the bottom of that page, equally colorful, it shows 4 different time periods and the leading economic powers of each of those time periods. 150 years ago, Britannia not only ruled the waves, it ruled the world economy. Germany, France, the Central Powers of Europe dominated the world economy. 50 years ago, the United States came to preeminence. Japan and Germany behind it. 20 years ago, the United States, and all of a sudden, a new flag appears, that of China. And finally, the projection for 10 years from now, most economists agree that there's no question that China will be the largest economy in the world, supplanting the United States and regaining the status that it had for much of recorded history, followed by another newcomer in third place, India, by virtue of its very large population. And how is this happening? This is happening because these economies are growing so quickly. So turn your eyes to the graph on the top of page 11. The red line is the growth of the Chinese economy. That's over the past 10 years. The line in the middle is the Indian economy, and the lines at the bottom are the developed economies of Europe and the United States. And you can see that as a result of those extraordinarily high rates of growth, the Chinese, the Indian economies have become large, they will get larger, and one of the reasons for this is shown in the graph at the bottom of that page, which is a question of demographics, and it also explains why the Japanese flag has fallen off the graph on the bottom of page 10. Demographics, to some extent, is destiny. The United States right now is in an anti-immigrant phase. It has an aging population. Its workforce, as a result, will fall. The United States is the yellow line on the bottom of that page. At the same time, the Chinese and particularly African and Indian workforces are still growing. More people power, more educated people, more consumers means bigger economies. I want to give you an idea of what's happening in Asia. How many people here have traveled to China? That's a lot of people. Like me, you were probably amazed at how rich the average Chinese person is now. If you look at the graph on the top of page 12, it shows you the evolution of the Chinese consumer market. The red section on the top right are affluent consumers, consumers who we would consider to be middle class in any context. And ladies and gentlemen, there are now 100 million of these affluent middle-class households in China. By contrast, Canada has perhaps 7 million middle-class households, and the United States perhaps 70 million middle-class households. There are more middle-class consumers in China than there are in the United States, and this can only grow in the future. One of the ways this has been experienced, and those of you who travel a lot, I'm sure, have encountered this, is in the Chinese expansion of outgoing tourism. If you look at the graph on the bottom of that page, page 12, the blue line shows you how much money is being spent by Chinese consumers on tourism outside of China. And what you can see is that graph has absolutely exploded. This is an indication of a wealthy society. People have money beyond buying houses and cars and appliances, money to travel the world. India is going to experience exactly that kind of explosion of mass tourism that we've seen in the last 10 years with the Chinese. And I can tell you that when I was traveling in New Zealand and Australia with my wife recently, we ran into a busload of Indonesian tourists. Asia in general is experiencing this middle-class gentrification, and there's going to be money to be spent. A couple years ago, we introduced to those of you who are here the phrase experiential consumption, that millennials in North America were spending their money not on goods, but on experiences, on travel, on tourism, on cruises, on rock concerts. This is happening in the rest of the world, and my colleague Ernest is going to give you a particular example when he speaks. So, what should we do about this? Well, it turns out that the United States and Canadian stock markets are not the only stock markets in the world. Stock markets exist elsewhere. And in the graph on the top of page 13, you'll see a list of the biggest stock markets in the world. And the United States still leads the list. The United States is still by far the biggest stock market in the world. Still 36% of the total stock markets in the world. But other stock markets are coming up quickly behind it. I'm not going to read the list for you. You can all read for yourself. But you'll notice that the next three are in Asia: China, Japan, and Hong Kong. Then you get three old European powers. Then you get India. And finally, in ninth place, you find Canada, whose stock market accounts for less than 3% of the capitalization of all the markets in the world. When we're buying Canadian stocks, and we are subject to what I call home court bias, we like Canadian stocks, we understand Canadian stocks, we get a tax advantage when we buy Canadian stocks, but they're only 3% of all the stocks in the world. If we ignore the rest of the world, we're ignoring 97% of the opportunities. And I want to show you at the bottom of this page what perhaps the most sophisticated investment group in Canada knows, and that's the Canada Pension Board Investment Group. If you look at the bottom of the page, you'll see where they hold their equities. They have 2.4% of your pension money in Canadian equities. They have 29% of it in other stock markets, and they have 7.4% in emerging markets, in markets not the developed world. I can tell you, ladies and gentlemen, that if it's good enough for the Canada Pension Plan Investment Board, it's probably good enough for me, and it's probably good enough for you too. Take a look at the pie graph on the top of the next page. That will show you the emerging countries, and by far, of course, the largest are China and India, as you would expect. So what are the benefits to you of having some of your assets allocated to these markets? Why would we do this? Well, number one, these markets, as they become more affluent, as they get more and more middle-class households, are buying more and more of the things that have already saturated markets in North America and developed Europe. So, for example, if you look at the chart on the bottom of page 14, the teal area or turquoise area shows you the rate at which cell phones have been adopted in those markets. And you can see that's where the action is, not in North America. Similarly, if you look at the top of the next page, where are the gains to be made in selling technology? Well, they're in India and China, Nigeria, huge population there, Pakistan. We would like to go where the action is. Clearly, it's easier to make money when we invest in companies that are working in countries that have very fast economic growth. Look at the graphs, the two graphs at the bottom of that page 15. One of them on the left compares China Mobile to Rogers. Nothing wrong with Rogers, we own it for many of you, but look at the growth rate of China Mobile compared to Rogers. And on the one on the right compares a large package forwarding company to Federal Express. Again, nothing wrong with Federal Express, but if you invest in a company that is growing faster, the odds of making money should be higher. So that's number one, faster growing countries, faster growing companies. Number two, and this is somewhat technical but really important, is that we don't want to own assets that all move in the same direction at the same time. Assets that move together are said to be correlated. So what we saw today in the North American markets was a very correlated market. Canada went down and the United States went down, and they both went down a lot at the same time. They were highly correlated. On days like today, what we would like to own are assets that don't go in the same direction. So your bonds and preferred shares today held their value. They were uncorrelated. Well, one of the advantages of investing in the world is that not all country stock markets move the same direction at the same time. So if we have a bad year with the Canadian market, maybe we would have a good year with the UK market or the German market or the South Korean market. Uncorrelated assets reduce risk in a portfolio. It's a powerful reason to own stocks in other countries. The very hard to read black and gray chart, I don't think you can see it in this light, but is worth examining at home, shows you the great extent to which emerging markets are not correlated to the North American market, and that's an advantage. The fourth reason is simply to get us out of a rut. We have far too much money invested in Canada. The Canadian stock market has done badly. Barry tells me that as of today, an investor in the Canadian TSX index has now made no money for 2 years, that we're back to sometime in 2006. That's horrible. We're guilty of this. We have too much money, too much of your money in Canadian stocks that are underperforming. We need to get out of that rut. We need to widen our vision. We need to look outward. Now, some of you are undoubtedly saying, isn't this risky? And you know what? You're right, there are risks. The first risk that will come to mind is currency risk. When we buy Chinese stocks, we're indirectly getting exposure to the Chinese currency. When we buy Samsung or Kia, we're getting exposure to the South Korean won. When we buy something in Britain, we're exposed to the pound. There is a currency risk. It's manageable. Once you've identified that it exists, you can handle it. The worst currencies in the world, places like Argentina in particular, which had a huge currency dip this year. Turkey, which I think saw its currency depreciate 19% against the US dollar in 1 week, obviously have to be small portions of any portfolio. You don't want to be exposed to that kind of risk. But currency risk is a real risk. Political risk is another risk. Look, we live in Canada. We had a little rebellion here almost 200 years ago. The United States had a civil war 150 years ago. We don't think any of our neighbors are going to invade us. We don't think that the governments, well, I was going to say, we don't think there's going to be government coups, but probably not. But that's not the case in some countries around the world. And if you invest in South Korea, you must be aware of North Korea. If you invest in India, you must be aware that it has nuclear weapons because its neighbor to the north, Pakistan, has nuclear weapons. And if you invest in Saudi Arabia, you must be aware of the structure of the monarchy there, and so forth and so on. China, soon to be the biggest economy in the world, is still a totalitarian communist state, and the head of Interpol can disappear and never be seen again. Heads of companies can be imprisoned or shot, and companies taken away with no compensation to shareholders. We take on political risk when we go abroad. We must be cognizant of it. Number 3 is volatility. Well, today we saw some volatility in North America, but let me tell you that in some emerging markets in particular, what we saw today is a weekly occurrence. We have to be aware of that as well. We have to be cognizant of volatility. So why are we doing it? Because we think that the benefits outweigh those risks, that if we identify those risks, we can manage them. There's a number of ways that we can invest internationally. I'm not going to go through them in detail. They're outlined on page 18. But let me say this. It's unlikely that Gordon and his team are going to be getting up in the middle of the night to trade on the South Korean stock market in won. I think there are better ways to do it. There is a thing called American depository receipts, which trade on the New York Stock Exchange and which allow you to invest in foreign markets by proxy. There are some excellent exchange-traded funds which track the largest and most important stocks in various countries. So if you wanted to be in China, you could get Alibaba and Tencent by investing in an exchange-traded fund. And most of these have very, very low management fees associated with them. And finally, and not to be ignored, is the fact that over half of the profits of the companies of the S&P 500 are now earned outside of North America. When you're buying Procter & Gamble or Johnson & Johnson or Apple or Microsoft or Google, you're getting exposure to those markets. The Chinese market may be the biggest market for cell phones. It may be the biggest market for search engines. It may be the biggest market for baby food. When you buy those companies, you're getting world exposure, and that's an easy way to do it. So, ladies and gentlemen, I'm going to conclude my remarks by saying, over the next year or two, please don't be surprised to see the Canadian part of your portfolio shrinking and some unfamiliar names cropping up on your asset list when you look at your reports or when you meet with your account manager. This is by design, it's important, and it's something that's going to happen, we hope, to all of our benefits. If you have questions or doubts, please, please speak to your account manager, and we'll tell you exactly why we're doing what we're doing. So I'm now going to hand the microphone over to Barry Schwartz. Those of you who don't know Barry very well might not know that Barry is a voracious reader of books about markets and investing. His office is full of them. I can't even imagine what his house looks like. But he reads them kind of like some people read the daily newspaper. As a result, his knowledge continues to grow, his experience continues to grow, and Barry's going to talk to you about his market outlook and our market outlook for 2019.